Did you know that dividends are taxed differently than your other income? And that there's actually a way for you to pay zero taxes on dividends? Hi. My name is Kat and I'm a chartered professional accountant. On this channel, we discuss Canadian tax, accounting, and personal finance, with the goal of helping you keep more of your hard-earned money in your own pockets. Today's video is all about how dividends are taxed in Canada. We'll go over what dividends are and how they're taxed, including a detailed example. At the end of the video, I'm going to share a tip that'll help you not pay a single penny in taxes on your dividends. So let's jump right in. First of all, what are dividends? Basically, dividends are the portion of their profits that companies pay out to their shareholders. In other words, when you invest in stocks, whether it's by buying a specific company's stock directly or via an ETF, there's a possibility that you'll get a cut of that company's profits in the form of dividends. Not all companies pay dividends, so if you're looking to earn this type of income, be sure to research dividend-paying stocks or ETFs. Dividend income is interesting because it's taxed differently than any other type of income. We'll dive into specifics in a second. But first, there are two types of dividends, eligible and non-eligible. Eligible dividends come from companies that pay higher corporate taxes, like big public corporations. Non-eligible dividends are paid by smaller private companies, usually those that don't pay as much in corporate taxes. This is important because the amount of taxes you'll pay will be different depending on which type you receive. So how exactly are dividends taxed in Canada? Well, since the company already paid taxes on its profits before paying out dividends, the CRA takes this into account. This means that you, as an individual, pay less taxes on dividends than on other types of income like your salary. This is due to the concept of integration. Without getting too technical, it means that the total taxes paid should be the same, regardless if the income was earned through a corporation or by the individual directly. The way the CRA does this is by grossing up the amount of the dividend you receive and then giving you a tax credit. The gross up and tax credit percentages are different depending on whether the dividend is eligible or non-eligible. Let's go over an example to see how this works. Before we go on, if you've learned something so far, please take a second to give this video a like, it really helps the channel. Let's say you receive a $100,000 eligible dividend. You'll be taxed on $138,000 and your dividend tax credit will be about 15% of that amount, resulting in federal taxes of about $3,200. If, instead, you receive a $100,000 non-eligible dividend, you'll be taxed on a smaller amount, $115,000. But the dividend tax credit is also smaller, around 9%, resulting in taxes of $7,600. This might seem like a lot compared with the eligible dividend, but now let's say you received a $100,000 salary instead. You'll be taxed on only $100,000 since there's no gross up, but there's also no dividend tax credit, resulting in almost $15,000 in taxes, which is a lot more than what you would pay on either type of dividend. To recap, eligible dividends result in less taxes for individuals because corporations have already paid a good chunk of taxes on that income. Since non-eligible dividends are paid by smaller private companies, who usually pay less corporate taxes, the amount of taxes you pay on those is a bit higher than on eligible dividends, but still much lower than on regular income like your salary. Bottom line, earning dividends is much more advantageous tax-wise than earning a salary. Now that we understand how dividends are taxed, I'm going to share a key tip to enable you not to pay a single penny in taxes on your dividends. I'm sure you've heard of the TFSA or tax-free savings account. But did you know that you can earn dividends inside your TFSA? That's right, a TFSA doesn't have to just be a simple savings account where all you earn is a small percentage of interest. You can actually invest the money you put in your TFSA into things like stocks and ETFs, which pay out dividends. By doing this, any dividends you receive are not taxable at all. In other words, dividends earned inside a TFSA are 100% tax-free. Investing via your TFSA is a great way of building wealth that many people overlook. I encourage you to look into this further if you don't have a TFSA or if you're using it as a simple savings account. I'll link to my video about the TFSA below if you want to check that out as well. Alright, so here are 3 important takeaways from this video. 1. Dividends are taxed way more favorably than regular income like a salary. 2. Eligible dividends cost you less in taxes than non-eligible dividends. And 3. If you earn your dividends through your TFSA, you won't have to pay any taxes on them at all. That's all for today's video. I hope you found the information helpful. Don't hesitate to ask your questions or submit special requests for future videos in the comments. Be sure to hit that notification bell if you want to be the first to know when a new video is released. Thanks for tuning in, and I'll see you next time.